Good evening. We're here for why gold still matters. So this evening, we're going to be talking about investing in gold with Invesco ETCs. I'm here. My name is Zoe, and I'm with Paul Syms from Invesco and Andrew from InvestEngine. We'll do some brief introductions, and then we'll leap into talking about gold. Could we just hop on the slide, please?
Thank you very much, Zoe, for hosting the webinar today. Good afternoon, everybody, for watching. Thank you for joining. I'm sure a lot of people on the call will have seen my face before and are familiar with me by now. But my name's Andy Prosser, and I'm the head of investments at InvestEngine.
Great, and thanks for inviting me back. My name is Paul Syms. I'm head of EMEA ETF fixed income and commodity product management at Invesco. Gold is one of our key products. So I'm looking forward to discussing the outlook for gold and why it still matters today for investors.
Awesome. I'll just quickly hand over to you, Andrew, as well, to do the compliance before we leap into the first question.
Thank you very much, Zoe. Yes, before we get going, I just need to mention quickly the usual disclaimer that your capital is at risk whenever you invest, that this webinar is for UK clients only, and that none of this is financial advice. So back over to you, Zoe, to kick things off.
Absolutely. And as a brief reminder, please do feel free to ask away any questions that you've got throughout the webinar. We will be coming on to a Q&A at the end. So as a question to kick you both off then, let's start with the big one. Why does gold still matter to investors in 2025? Paul, over to you.
So I think to understand why it's still important today, it's worthwhile just looking at the history of gold and its sort of store of value, its show of wealth. Gold has a very long history as a show of wealth dating back to the Egyptians, probably around 5,000 years ago. Then it sort of became a bartering tool before becoming something that was basically backing coins. It was what early coins were made of around 500-600 years BCE. More recently, if we look at fiat currencies and the development of currencies overall, the gold backed a lot of global currencies, including the US dollar, until the early 70s. And then, even though we've come off the gold, or the US have come off the gold standard, all that time ago, 50 years ago, I think from an investment perspective, which is, I guess, why we're here today, the interesting thing about gold is that it behaves differently to many traditional asset classes. So it performs differently in different stages of the economic cycle, which can be quite useful from a diversification perspective. So it can work well in a multi-asset portfolio. It also has some inflation hedging capacity. Gold tends to be one of the few asset classes that can perform well during periods of inflation. And then it also tends to see quite strong demand in periods of market volatility. So when we're seeing equities having a bit of a wobble, you quite often see strong demand for gold. It's sort of seen as a sort of an asset class that does well as a flight to safety. So it has some interesting perspectives from an investment outlook.
Awesome. Anything to add to that, Andy?
Yeah, I've actually seen a question come up in the chat about gold and diversification, because gold is often seen as this kind of safe haven, right? And I think there are two things, as Paul mentioned, that people tend to hold gold for, right? One is it's a safe haven against equity market crashes, and the second one is gold being a safe haven against inflation. So if we just kind of like take both in turn, just to expand on what Paul was saying a little bit. Absolutely right. Gold is seen as a risk-off asset. It's one that tends to go up when markets go down. 2008, great example. The markets, if we measure that as the MSCI World, that was down about 30% in sterling terms during the 2008 crash. But gold, it absolutely shot through the roof. Over that same time period, it almost doubled in value from £330 an ounce, this in sterling terms, to £660 an ounce. I checked the stats yesterday to make sure that was accurate. 2000 dot-com crash, the same thing happened. The market fell even more. It was 50% in the dot-com crash. And although gold didn't double, it did rise about kind of 17%-ish while the market crashed. So over 60% of outperformance there. This year, another good example, we had this big sell-off between February and April with Trump's tariffs. I think it was about 15%, something like that. But gold, totally flat through that whole sell-off, through like February to April time. It held its purchasing power really well, didn't fall at all. And thanks to the really good performance it's had in the rest of the year so far, it's now up 20%-ish for sterling investors this year compared to the market, which is still down. It's underwater only by about 1%, but it still had some really good outperformance. Now, obviously, that's not the case for every single market sell-off. It doesn't go up every single time the market goes down, but it does have a pretty good history of at least falling less than the market when the market falls. I think part of so it means that when markets crash, investors get worried, they tend to flock to things which are safer, bonds, cash, gold, and the dollar. So you get that kind of double whammy of you're buying gold, which is a risk off asset, and you're buying the dollar as well, which is also a risk off asset. So that's great. Now, before I was saying that during 2008, gold went from 330 to 660-ish. About 30% of that was because of the gain made from the dollar. So gold only went up like 45%-ish, something like that in dollar terms, but in sterling terms, it was a lot more because it has that FX effect from having your asset price in dollars. So really helpful there. It doesn't have like the dollar's not doesn't have a really long history of being a perfect hedge. Sometimes it helps, sometimes it hurts, but it is at least kind of uncorrelated. And actually, speaking of currency and the effects on gold, I was looking at Invesco's gold ETFs on the platform today, and one of the particularly attractive features of the Invesco gold ETFs is that you have the choice. You have a currency unhedged version on there if you want to have that dollar exposure. If you think that the dollar is going to offer that extra protection during a crash.
Yeah. Just temporarily lost you there, Andrew. Hopefully.
I've got a bit in a second where I can talk through the platform where to find the Invesco ETFs, and we can talk tickers and things like that. But anyway, yes, on the point on crash protection, no crash is perfect, no crash hedge is perfect, but gold's been pretty good at least losing less than the market during a crash, and it's pretty uncorrelated as well.
Yeah, that makes a lot of sense. And I think it would be good at this point, actually, for those watching and for someone new to gold investing, perhaps. What is the difference between owning physical gold and investing through a gold ETC like the ones that you've just mentioned there on the platform?
Okay, so I can take this one. Owning physical gold means that you hold like the tangible metal itself. You own gold bars, you own gold coins, and the value of each bar is tied to its weight, it's tied to its purity. It doesn't hold any counterparty risk if it's in your possession, i.e. that means you don't have the risk that somebody else is holding it for you, and then they lose it or they go bust or they get robbed or something like that. You don't have that counterparty risk, which is a plus. But on the downside, you are responsible for making sure it's stored safely. You have to get a big old safe to keep it in. You have to pay for insurance. You have to pay for authentication fees to make sure you're not getting ripped off and what you're buying is actually really pure gold. And it's also usually more expensive to buy when you buy physical gold itself. Premiums, you always pay a premium over what the actual gold price is because the person that's selling it to you has got to make a margin, and they're kind of 1 to 5% ish, which is typically a lot more than you would have to pay if you were buying it in an ETC. And an ETC, just to get the jargon out of the way, that's an exchange traded commodity, which is similar to an ETF. You can kind of see by the name, they're both exchange traded. So stands for exchange traded commodity, and it's an exchange traded vehicle that's backed by physical gold. They trade on stock exchanges just like a normal ETF, just like shares. So they give exposure to the gold price movements without the kind of logistical challenges and the expenses of owning the physical gold bars themselves. So each share of like your ETC will represent partial ownership of some gold held in a vault by the custodian, whoever's Invesco's custodian will be. They'll have a vault somewhere with lots of gold bars in there, and your ownership of that ETC will represent ownership of those gold bars. Now, gold ETCs do obviously carry an annual management fee to cover custody, insurance, admin expenses. And I think correct me if I'm wrong here, Paul, but the Invesco ETCs are 12 basis points, so 0.12%.
That's correct.
Yeah, and they're really liquid. One of the main benefits of the exchange traded vehicles is that there's much lower spreads to buying or selling compared to normal physical gold. There is also the risk on the ETC of the counterparty defaulting. So should the ETC issuer, i.e. Invesco, go bust, or the custodian of the physical gold go bust, or get robbed, something like that, then the recovery of the underlying gold could be delayed, jeopardized. And how much of a risk that is, maybe Paul, you can talk to this. depends on who you choose as your ETF issuer or ETC issuer, and who Invesco chooses the custodian. Now, obviously, we're an ETF platform, so we love all things exchange traded. We think they're great. They come with great liquidity, super accessible, really transparent. They've got really low costs. You have the choice with the Invesco Gold ETCs of being currency hedged or not. You can hold it alongside the rest of your portfolio, which you can't do if you just got gold in your safe. So holding an ETC is a really good low-cost way of introducing gold into your portfolio. Now, I was going to go through, and now's as good a time as any to do it, to go through the product demo. But Paul, maybe you can have a chat about how the gold is stored and how the kind of relationship between the ETC and the physical gold works with the Invesco ETCs.
Yeah, sure. I mean, to be quite honest, you've covered most of it extremely well. You know, the idea of a gold ETC, you know, the way our product works is that for anybody that comes in and invests in our gold product, we issue certificates against that. So you get a certificate that gives you an entitlement to the gold, effectively. All those certificates are physically backed by gold. The gold is stored in London. In JPM's vaults, we have a dedicated vault within that. So we have an allocated vault that purely holds the bars that back our gold ETCs. We do also apply a swing bar approach. It's a slightly technical term. It does mean that we always have more gold in our allocated vault than the value of the certificates. Effectively, whenever there's a creation of the certificates, the gold gets delivered, and we'll always have a little bit more because of the size of the bars. We'll always be owing the unallocated vault a little bit rather than them owing us some. So you have that real security that this is all fully backed by gold in a allocated vault that it, you know, safely stored in London under JPM's custody. I think, you know, when you look at that. You know, London is a key storage city for gold. There's over 8,000 tons of gold stored in London. That's more than $900 billion worth. So, you know, even though our ETCs are combined are over $20 billion in assets under management, it's a pretty small part of the market. There's plenty of liquidity, plenty of gold in London to be able to meet any of that investor demand. So I think when you're looking for you know, the differences between products where gold's stored, the liquidity, the ability to access that, all sort of works well with the way that we've set the product up. And you know, we've been doing this for 16 years now, so it's got a proven track record as to how it behaves and how it's performed, which is exactly in line with the price of gold, less fees.
Yeah, brilliant. And I think you've touched upon some of the key points there that people can look out for when they're assessing ETCs, of course, where the gold is stored, as you just mentioned there, what the liquidity is and what the costs are. And I think it's a great moment there to hand over to Andrew just to have a quick look at what this looks like almost in real life on the platform. Andrew, if you want to.
Yeah, let's hope the tech plays ball this time.
Crossing fingers.
Okay, here we go. Should be sharing now.
I can only see it
takes a while to kick in sometimes. I think
we're
up and see it now.
Internet hasn't been fed in a while. So here we are. We've got the InvestEngine platform up. What I'm going to do, this is a nice demo account. I'm going to scroll down to my DIY1 portfolio, which is the one that I usually use for these kind of demonstrations. And what I'm going to do, I've decided that I want to put some gold into my portfolio. This is how my portfolio is looking at the moment. We've got some performance here. I'm only holding 2 funds, but I want to add in a little bit more diversification. So I'm going to click Add Securities, and then it'll take you to this screen where you can have a look at all the different investment options available. What I'm going to do is, so we have 3 partners up here. We have Invesco up here. So super simple. You just click the Invesco tile at the top here, and that brings you to the Invesco page, which has got lots of great content from the Invesco team. More about gold, if you want to find out more about gold there. This has got all of their ETFs on the platform here. So if I scroll down, I should be able to pretty quickly, yeah, here we go, find the Invesco physical gold ETF. So we can click that one. And here we go, you can see gold with absolutely amazing rally so far this year. We can scroll down here. We can see what we're buying here. We've got a nice description of what the ETF does, who Invesco are, what the gold price is. Usually that's for the index if it tracks an index, and then all the different attributes of the ETF here. So we can see this is the currency hedged ETF here. So this was SGLS, I think, yeah. And if you wanted the unhedged version, that is SGLP. So very similar, just a different final letter. And I've decided I want this currency hedged version, so I'm just going to click add to portfolio. You can see on the top right here, that's now been added alongside the other two funds. Next screen, I can decide how much I want. I'm going to put 10% here. I'm going to take it out of bonds, so that can go down to 40. Make sure it all adds up to 100. Very good. We've got an equity look through, which shows what the difference in equity allocation is for all the different regions, sectors, holdings. Obviously not relevant because we're putting in gold, which isn't a company. So we will save and continue. And we can see the target weights have all been updated, which means that when I scroll down, I now can see here, right, okay, I've got a target weight of 50% in this fund, 40% in this fund, 10% in this fund. These are my existing weights. So all I would need to do now is rebalance my portfolio, which I can do if I click options and then rebalance. Now I'm not going to do it because it would probably break, given this is a demo one, but that's how you would rebalance everything back to the target weights. If you haven't invested yet, if this is a brand new portfolio, you click either invest, which is to invest like a lump sum, or set up a savings plan, which is if you want to do a kind of regular investing. If you got a couple of £100 every month that you want to regularly invest into this portfolio, you can set it up that way. So that is a very whistle-stop tour of the platform and how you would go about adding one of those Invesco gold funds into the portfolio. If you want to find out more about the gold ETCs or any of the Invesco ETFs that we have on the platform, just go back to that kind of range page and just click the Invesco tile at the top. All the information's there.
Yeah, that's super helpful. And I noticed that you put in 10% there for the allocation to gold. And you've mentioned a few times, I think both of you, that gold can be used to diversify the portfolio. Could you just talk a little bit more about how, and if there is kind of a specific or maybe an ideal allocation, if you like, that you would aim for when it comes to gold?
Yeah, I can take this one then. Yeah, it can absolutely be used to diversify a portfolio, first of all. And that's because of the reason that Paul was talking about at the start. It can do well when markets fall. It has a low correlation with equities. So in theory, adding it to your portfolio should increase its risk-adjusted returns. Now, the second part of your question is a much trickier one. In terms of how much to hold, we obviously can't offer financial advice here. But we can talk in kind of generalities around how to think about position sizing in general. And I think there are a couple of ways to think about this. One way to think about it is to weight your positions in your portfolio according to your confidence level in that position. So for example, most people have a high allocation to equities because they have a high level of confidence that equities are going to provide the highest returns over the long run. They also hold bonds because they've got a high level of confidence that the bonds are going to provide income and cushion the portfolio when markets fall. And you see this for like stock pickers as well. They tend to overweight those stocks that they have the most confidence in, i.e. those stocks that they think have the best chance of outperforming. And you can apply the same logic to gold as well. If you don't have much confidence in gold, but you still want it in your portfolio for those kind of crisis moments when either markets have a big drawdown or inflation spikes, then maybe a kind of lower allocation, under 5%. If you have more confidence, then you can hold kind of closer to 10% or maybe even more if you're really confident in gold. But I think another way to think about it as well to help frame that is in relation to your risk tolerance. So for high risk investors, those that have the ability, they have the willingness to take investment risk, they probably want more allocation to equities in their portfolio and a lower allocation to diversifiers like bonds, like gold. But for those who are kind of more balanced investors, which to be honest, I think is most people, they're kind of those investors who would struggle to watch their portfolio fall 30%, 50%, the numbers that we were talking about before in 2000, 2008. A higher allocation to diversifiers like gold can make a lot more sense because you want to dampen those drawdowns as much as possible to increase the chances of being able to stick with your portfolio when the times are tough and markets are falling. So I don't think there's an ideal allocation, but I'd say your allocation should probably be a function of your confidence combined with your risk tolerance.
Yeah, that seems to make a lot of sense. And we've spoken a lot there about kind of what gold can be useful for in a diversification sense. But Paul, in your view, is gold more of an inflation hedge or a volatility hedge today? Or perhaps both?
In all honesty, without wishing to sit on the fence, I think it's both. I think when you look at sort of the inflation hedging potential, really it's only gold and potentially broad commodities that out of the major asset classes that tend to have a positive correlation to both the level of inflation and the change in inflation over the very long term. So we've done sort of long-term studies on this, of looking at this versus US inflation over sort of 50-year periods. And equities don't tend to perform too well in periods of inflation, nor do traditional bonds. And a great example of that would have been sort of 2022. We obviously saw a spike in inflation after extremely low rates during COVID. That spike in inflation coming out of that period, which meant that central banks had to hike rates very aggressively to combat it in inflation, which was a pretty harsh environment for both bonds and equities, with the backdrop of Russia, the Russia-Ukraine conflict as well. At the same time, gold did pretty well in that environment. I mean, it did well on the initially on that sort of risk off, that flight to safety on Russia invading Ukraine. Came back a little bit, but was still sort of marginally positive for the year. But you have that sort of combination of there was the inflation hedging part to start with, and then there was the conflict. And it did a little bit of both. So in all honesty, I think this works well in both environments. Gold tends to sort of, it's when you get an inflation shock that gold will probably do a little bit better in that short term. But then that flight to safety in periods of market turmoil, geopolitical risk, that kind of backdrop, we can see flows going into gold ETCs at those times, because it does provide some sort of stability generally in that environment.
Absolutely. I think there's nothing wrong with sitting on the fence, especially when it's such a complex matter like that. Could you talk a little bit more as to how institutional investors like central banks are positioning themselves in gold right now, and perhaps as well what individuals could learn from that too?
So, I mean, central banks, the demand from central banks has increased massively in the last few years. And it's interesting sort of to maybe sort of add to what Andy was saying earlier about the dollar and potential safe havens, and historically the dollar and US treasuries have been perceived as those sort of risk off assets. They've tended to do well in times of volatility and been that sort of safe haven type of asset class. That's starting to change a little bit. There's a little bit of concern about the dollar at the moment, a little bit of concern about treasuries, and the overall budget deficit in the US, which is just leading to a little bit of a concern over maybe the longer end of the treasury market, the longer dated bonds there, a little bit of concern over the dollar. The dollar's obviously down a reasonable amount year to date. And it doesn't look like that's going to reverse short term. So gold can be the sort of, again, the diversifier. It becomes a different sort of safe haven of asset class. What we've seen, if you look at the traditional drivers of demand for gold, jewelry is obviously a very strong driver of gold demand. That tends to be the largest part of demand for gold. Outside of that, you have sort of retail investment and ETCs, which are a combination of retail and institutional, and then central banks. Now, central banks, 4 or 5 years ago, were probably buying about 100 tons of gold a quarter, around that sort of level. That's now up to the last 3 years, that's probably gone up to about 250 tons a quarter. And this is a little bit of that diversification. I think this has been an ongoing theme. I think post the Russian invasion of Ukraine, there's been a little bit of a sort of a de-dollarization to central bank assets. They're rebalancing some of their reserves away from treasuries, away from the dollar, and actually holding physical. So the likes of gold becomes a very useful tool within their overall allocation and their reserves. So that's really, and I think that's one of the things that's really been helping drive the price of gold recently. Apart from some tensions and geopolitical tensions and other parts, that demand from central banks has definitely helped push the gold price higher. Because if you think about gold, the other side of it is it's very hard to sort of turn the taps on. You can't, just because the price has gone up, you can't just produce a lot more gold. Extracting gold from the ground takes time, effort, a lot of investment. So even though at these levels of pricing, it's very profitable, it's still, we've had a lot of the easy gold. So it's very hard to really ramp up supply even though demand has increased over the last few years from central banks.
And that sanctions point, I think, is a really interesting one, right? Because the kind of US government have the ability to freeze foreign holdings of dollar-denominated assets via kind of executive order, which means that any nation's official reserves that are parked in dollars or dollar-based investments can just suddenly become inaccessible. So 2022, great example, the US froze large swathes of Russia's FX reserves following its invasion of Ukraine, as you mentioned earlier. And in early 2025, earlier this year, like a single tweet raised the prospect of sanctions on all of Colombia's dollar assets. So I think there's quite a lot of diversification going on in particularly emerging markets. And the dollar share, I was reading an article the other day saying that the dollar share of global foreign exchange reserves has slipped from about 70% in the early 2000s to about 60% a couple of years ago, according to the IMF. So yeah, I think there's a lot of central bank influence in the rise of gold and de-dollarization and just a bit more diversification from central banks, which retail investors can get access to as well. Central banks diversifying, retail investors can also diversify.
Absolutely. I think it's really useful to understand that central bank positioning on gold and also how that can translate for retail investors sat at home essentially listening to this webinar today as well. So I think we'll hop on to some of the questions that have come in. One of the main questions that I can see popping in is all about when you mentioned that the particularly Invesco and other ETCs can be hedged or unhedged. And a few people are a little bit confused about what that might mean. Could one or both of you just quickly leap in on that one?
Go on, Paul, let you take that one.
Yeah, sure, happy to take that. So gold is priced in dollars. So if you buy the unhedged gold product, you are exposed both to the price of gold and also to the movement in the dollar versus sterling, if you're a sterling-based investor. So you're kind of taking on two risks there. Now, for gold itself, gold actually tends to perform well in periods when the dollar is weakening. So there tends to be a little bit of an offset there. However, if you're an investor that doesn't want to take that risk on the dollar and you just want to effectively invest in gold to diversify your portfolio, or potentially to speculate that you think the price is going to continue to go up, to minimize that FX risk, what could happen to the dollar if you do think the dollar could continue to weaken, then you can go to a currency hedged gold product. So we offer this in both sterling and euro hedge, just to have the full suite of products there. And you're not fully eliminating currency risk because there are other influences here, but you are minimizing that currency risk. So you'll not be exposed to that same level of, if you expect the dollar to weaken by 5 to 10%, you are sort of putting a buffer there. You're going to be more focused on the price of gold than what's happening to the dollar in your portfolio.
Absolutely, that makes a lot of sense. I think you've sort of touched upon this one, but there's a question come in about how gold has, of course, been on a significant rally over the last 20 years. Do either of you have any concerns about this being actually overvalued by historical standards, and perhaps due to the access that lots of people have now through ETCs, for example?
So, I mean, the way I take this is more about the diversification benefits of gold and how it interacts with other assets within your portfolio. If you look at if you look at US equities and concerns over the Mag 7 and whether they're overvalued, if you look at any asset class at any given time, it can look overvalued. I think a lot of this is about diversification. Now, when it comes to gold itself, sure, we rallied to $3,500. We've come back a little bit, and we're seeing some swings on day-to-day news flow, and that's going to happen. If geopolitical tensions are ratcheting up, you're going to see maybe the gold price go up, and then if there's sort of a reduction in those tensions and ceasefires, then the price of gold can come down. Which is, these aren't designed for short-term investment. This is really about the long term and how gold can fit into your overall portfolio to have that diversifying nature, as Andy sort of mentioned, depending on your sort of certainty and your outlook, and also your time horizon, will kind of determine what percentage of gold you may wish to hold. But having some gold in your portfolio, even at relatively high valuations, can act as that diversifier. It can provide that little bit of inflation hedge, and it can provide a little bit of a sort of a risk-off safe haven asset to your portfolio. As Andy said, again, when we looked at the April volatility and like the S&P 500 down post the tariff announcements, but gold held in very well there. So if you just want to sort of maybe reduce a little bit of volatility in your portfolio, have that diversification, gold can be quite useful in your portfolio from that perspective.
Absolutely.
Just to add on to that point as well, it's probably useful to kind of set expectations in terms of the long run returns that investors can expect from gold compared to equities, compared to bonds and the kind of traditional asset classes. And I think gold's a really interesting one because it's got a weird historic performance. It's kind of split into two periods, right? You've got before the gold standard and then after. So I like taking a step back in history. So if we go back to America in the 1930s, they were trying to stem the outflow of gold from the US during the Great Depression. So to prevent people from hoarding gold and stalling economic growth and from withdrawing gold, President Roosevelt signed an executive order that actually forced all Americans to convert their gold coins or their gold bars into US dollars. And it was then totally illegal to own gold. You literally weren't allowed to own it, let alone invest in it, trade it, anything like that. Then we had the gold standard kind of 10 years later in the 1940s, where individual currencies were priced in a set amount of dollars, which in turn was backed by a fixed amount of gold. I think it was about $20 an ounce, something like that. And that lasted until 1971, at which point the gold price was no longer tethered to a single currency. And then the gold standard, it ended in 1971, but it wasn't actually made available for trading and legal to own until 1975. So although we've got loads of really good historical data for other asset classes, stocks, bonds, we've got data going back to the 1920s. Some data sets go back even further than that, although the accuracy of the data is dubious. Gold, as we kind of know it today, as a fully liquid, fully tradable, fully investable asset class, didn't really exist until 1975. Since then, it's interesting to see how it has performed against bonds and equities. It's not kept up with equities, as you'd kind of expect. Equities have generated 9.5% a year-ish since then. Equities, obviously high risk, high reward. Compared to bonds, though, it's actually much, much closer than I expected. I looked the other day in preparation for this and was surprised at how similar gold returns over the long run have been to government bonds. So US government bonds, this is to keep the currencies like for like, both priced in dollars. Government bonds returned an average of 6.2%-ish since 1975, and gold's at 5.9. So they're within 0.3% of each other on an annualized basis. Obviously, gold has benefited from this really huge rally we've seen in the last couple of years since the middle of 2023. It's up about 70% in the last 2 years. But still, long-term returns are more similar to bonds than you might expect from an asset class which doesn't produce cash flows. Now, having said that, performance is one side of the coin. And I saw somebody in chat asking whether gold was a good thing to hold for your house deposit if you had a house deposit, say, for 1 or 2 years. The other side of gold is risk. So in terms of risk, I think gold is closer to equities than it is to bonds. So it can go up and down a lot more than bonds can. And while that might sound scary, and it's for clarity, not something you should be putting your house deposit in if you're wanting to get a house deposit in 1 to 2 years. Absolutely not. That is cash. Keep it in cash. If an asset has a high volatility in a portfolio, but is also uncorrelated or is ideally negatively correlated, then it actually should do an even better job of reducing your overall portfolio risk because it has the power to zig more when your portfolio zags, if that makes sense. Because it's more volatile, it can go up more. So one of the issues with short-term bonds or cash as diversifiers in your portfolio is that they will never go up that much when markets fall. They might go up a bit, but not that much. So having a more volatile diversifier in the mix should, in the long run, make the journey smoother for you.
Certainly makes a lot of sense. I'm going to pull 2 questions into one here, which is there's been a question come in about Invesco's competitive advantage over other ETCs, but also where the data can be found on perhaps some of those competitive advantages that you're going to talk to, hopefully, Paul. So I'll hand that one to you if that's all right.
Yeah, sure. I mean, to be quite honest, this is one of our simplest products. It is issuing certificates backed by gold. And when you're talking about something like that, there's not a huge amount of differentiation within the market. So from our perspective, we have one of the largest gold products out there, one of the most liquid. As I say, when you're looking at certain aspects to which gold ETC to look at, we're using JPM as the custodian in London. Using JPM's vaults, we have the allocated vault in London in their vaults. Very low fee, 12 basis points, as Andy mentioned earlier. When looking at this, you also want to sort of make sure, one of the advantages of the ETC is the trading cost. So the fact that you're not exposed to that same sort of bid offer spread that you might see by buying physical gold, and the premium you have to pay to buy it, and then the discount you receive when you sell it. So ours is one of the most traded products on the London Stock Exchange, gold products. So it's up there in terms of liquidity. And it's basically, we've got that 16-year track record of it performing bang in line with the price of gold less fees. From a perspective of the actual bars that we hold, the LBMA, London Metal Association, brought in sort of responsible gold guidance back in 2012. So that was about looking at where the gold comes from, where it's sort of how it's refined, and that responsible gold guidance is just about ensuring that the producers adhere to things like the UN Global Compact. So being a single product, being a single asset, you can't do ESG, but you can have that responsible gold aspect to it. So this is all sourced responsibly. We endeavour at all times to only have post 2012 bars. That is the case at the moment. There would have to be extreme circumstances for us to ever receive, there'd have to be an incredibly large trading volume going through for us to accept pre-2012 bars. So this all sort of adheres to those responsible gold guidance standards. So they're the kind of things to look at. And, as I say, London is a huge warehouse basically for gold. There's huge amounts of liquidity there. So, I think we've got a very strong product in this area.
Certainly seems compelling.
And just to chip in there, I've seen there's been a couple of questions in the Q&A around the Invesco ETFs, particularly the TER difference, which you just mentioned, Paul. It is 0.12%, so 12 basis points for both of them, right? The hedged and the unhedged. And in terms of the tickers, I know there were some people that were asking, I did go through it in the presentation, but I appreciate it might have been a bit quick. The tickers, which is the kind of 4-letter code for the unhedged Invesco Gold ETF, is SGLP. So if you just type in SGLP to the search bar, that one will come up, and SGLS for hedged. Sorry.
Awesome. No, I was just going to say that sustainable argument is really compelling as well, and it certainly makes it a little bit different. But we're very much reaching the end there. It's been fantastic. I don't know if either of you have got any final sort of notes that you'd like to add at all, but it's been brilliant and certainly informative.
I mean, sorry,
Paul,
I'm just going to add, I think, but when you're looking at gold, I guess one of the things is it becomes very tempting just to sort of look at gold as something to speculate on where the price might get to, especially when you've had sort of a rally and the likes of that. I do think investors should be sort of looking at this, as I say, more from a diversification perspective in their portfolios. I think gold kind of has a place in a lot of portfolios for that diversification purpose, for that little bit of inflation hedging that it can do, and for times of instability, market volatility. It's nice to have that in your portfolio. So although you don't need huge amounts, I kind of like having a little bit of gold in most portfolios most of the time.
I was going to say, as my final thoughts, just thank you, Zoe, for hosting today. I think you did a really good job. Thank you, Paul, for your time, your insights. I think it was a really good discussion. thank you to everybody who's dialed in for joining. I hope you can join the next webinar. If you do want to find out more about these gold ETFs or any of the Invesco ETFs, just click that Invesco tile that I showed you before at the top of the investments page, and you'll find all the details there. Thank you very much.
Thanks very much.
Thank you.
Good evening.